from February 19th, 2025 to April 8th, just 34 trading days, the S&P 500 index fell 19%. And while it wasn't quite the 20% that economists use to define a bear market, it certainly started feeling like it. Hey everyone, Spencer Reese here from militarymoneymanual.com, joined by my co-host Jamie. Jamie, today on the podcast, I want to talk about more the touchy feelings side of investing. We can call it like a gut check. And I think this is a great opportunity now that we're recording this episode in July and the US stock market has recovered. And in fact, it's not just recovered from the drop that we saw in April of this year, but it's positive for the year. It's up almost 7% year to date. And I think it's a great opportunity where people kind of, once the stock market starts doing okay or decently or just isn't negative, people kind of let it drop to the back and it's not front of mind anymore. And it's a great time to assess, okay, how did I react? How did I feel during the roller coaster ride that was April? And how can I adjust my strategy or make sure that I create an automated plan, like the LADS method, the low cost, automated, diversified, simple investing plan that I talk about in my book? How can I create a plan that I can successfully implement through the good times and the bad times?
Yeah, I think now is the perfect time, like you mentioned, to do like a little bit of a debrief or an after action report. And we're used to doing that at work. And you have to get out of that scenario, get out of the combat, get out of the training environment, and then debrief. And now's the perfect time to do that, especially, if you have a partner or a trusted friend, a spouse that you can talk about this with and say, what did you feel in April when you heard the news talking about the end of the dollar or how everyone needs to go have gold and this is why you need gold or this is why you should whatever, change your investment philosophy with the stock market? And there was a lot of panic, but you got to remember that that's how the news companies make money, is by selling the fear and the headlines that are going to attract attention and get you to click, which then means marketing dollars for them. And if you can remember that they are incentivized to sell panic, and then now you can go back at it and look at what mindset do I really want? And then you can maybe even write that down as an investing philosophy, a personal investing philosophy like Spencer has talked about before. And then that way, next time it comes up, you know what to expect.
Yeah, I remember at the time, Jamie, when the stock market was down 19%, some of the headlines, I went back and looked at the New York Times, the Wall Street Journal, a couple investing blogs, and some of the headlines I pulled were, how bad can this get? Was the question they were asking. Or another one was, a recession is on the way. Buying when the stock market is down 15%. And this is one of my favorites. Index investing is broken. And of course, you always see the headlines about the FIRE movement is dead. In 34 days, apparently the entire global financial system just completely collapsed because the S&P 500 was down 19%. It's just ridiculous when you think back on it and you're like, yes, there was uncertainty, there was doubt, there was fear, but it wasn't the end of the dollar, which we can, now that we're looking back with, the grand vision of 3 months of hindsight, we're still using the US dollar for all of our transactions. Here we are 3 or 4 months later. International stocks have done better this year. So if you had an investment strategy that included international stocks, hey, you're finally seeing some benefit of that. But the other thing I want to address here too is when the stock market was down, there's always something else going on, right? It's not just that the stock market is down in an information vacuum. And if you think back in just the last couple of years, the last time the US stock market was down over 30%, we were at the beginning of a global pandemic that we really hadn't experienced since, maybe the 1920s, the 1930s. And everybody likes to throw around these, we live in unprecedented times. And that's almost never true. Most of these times are precedented, or there is some precedent for them in the past. The key thing to focus on is when the US stock market is down, there's other terrible news happening. And this time in April 2025, there was trade wars, there were tariffs, there were inflation fears. The Fed was talking about keeping interest rates high. If you just are a creature of the news, if you're just following the news cycle and reading every article or doom scrolling on your phone, it can very quickly increase your fight or flight response. And you think, okay, I have to do something. I have to take action. It was Warren Buffett, he turned the old phrase around on its head. Instead of saying, don't just stand there, do something, he liked to say, don't just do something, stand there. And I think that's the important thing for the long-term investor, the long-term military investor who's not focused on the headlines of today. They're looking at a decade, or, if they have children or grandchildren, they're looking at a century-long investment horizon.
Yeah, that's exactly why we talk about zooming out on the chart when you look at what the S&P 500 or what the total stock market has done. When you look at the day-to-day or sometimes even the hour-to-hour, if you're not specifically doing that for a purpose, like you are trading hourly or daily, if you're a long-term investor and you kind of go with the philosophy that Spencer and I talk about on this podcast, you shouldn't be checking your portfolio every hour. And all that does is incite more panic and more fear. Because when you zoom out on that chart, you see that even with the dips, it's built in, it's how the market works. It just is how it works. And if you didn't study economics in college like Spencer did, that's all I can say. It's built into there. It's going to go up. It's going to go down. There's corrections, but it's healthy for the market to have corrections. It's healthy. It's a sign of goodness when it comes down and then goes back up. And so far, for all of history of the U.S. stock market, it always has come back up. So instead of panicking and saying, oh, let me sell a bunch and try to avoid the losses, I'm going to sell a bunch, you just got to calm down, revert back to your personal investment philosophy, which hopefully involves something along the lines of, I'm a long-term investor. I'm looking for 20, 30, 40-year time horizon. And I believe that in the long run, decades from now, the market will come back up, and not looking specifically at what it's doing today or what the news is saying.
For myself personally, Jamie, one of my stated investment policy goals for the last couple of years has been to move from 100% stock allocation to add some bonds. And the reason for that is basically to reduce the volatility of my portfolio. When you're young and on your journey to financial independence, J.L. Collins talks about it in his Simple Path to Wealth book. It's okay to be 100% stocks, and it's okay to, when your investment time horizon is 20, 30, 40 years, it's okay to assume that volatility. And a lot of people like to talk about risk, and what they really mean in finance when they talk about risk is how much volatility are you going to see in that portfolio day to day, month to month, year to year. But for a long-term investor, I think the real risk is that you don't achieve the long-term compounding interest that you would if you had just put your money into a simple S&P 500 index fund. And for most military service members, the easiest way to access that is the C fund and the TSP, the Thrift Savings Plan. When we have a big stock market drop like this and it recovers, it's a good opportunity. Like for me personally, I looked at that and I was like, look, I've been in 100% stocks for a long time, 100% stock index funds for a long time. I've been wanting to make this move to 10% bonds. And now that I just went through this 19% drop in recovery, I can feel how much I reacted to that drop and how much more comfortable I would have been if I hadn't seen as much drop because I was in 10% bonds. So the time to make that change, though, isn't during the crisis. The time to make that change is after the crisis. And this is the opportunity now. So it's easy now that the market's recovered to just get lazy and say, oh, you know what? Maybe 100% stocks is the right way to go. But no, now is the opportunity that the market's recovered to say, okay, I need to implement this plan that I've had for years now and just haven't been able to get around to it. So I'm going to slowly start reallocating my portfolio so that in the next couple months or within the next year, let's say, I'll be at the 10% bonds, 90% stocks.
I think that's an important note to highlight to the listener is that even with all the money, like living and breathing money, you still felt something when the market dropped 19%. Like you're not immune to concern about the market when the news is out there.
Oh, absolutely. I mean, I remember some of the text messages that you and me were sending back and forth to each other around that time. And we had a lot of conversations and text messages back and forth, JB. And, looking back through our history here, like I was sending, some of those podcasts that J.L. Collins did as the coronavirus crash was happening. And it's basically like reassuring you, like, no, this is okay. This is normal. This is what the stock market is supposed to do. It reacts to new information. It implements new information very quickly, and it reprices based on that new information. And that's okay. That's not a bug. That's a feature. And you have to understand that at the end of the day, you own those shares in those companies. They are producing products and they are producing profit, and you will benefit from some of that profit, whether it's through dividends or through share price appreciation.
Another important piece of this is that you're not actually losing money unless you sell. So if you sell, you're locking in your losses. So that's why you need to revert back to your philosophy. Just like we do if we're going into a training scenario or we're heading into combat, or like something where we're working with our team ahead of time, and we try to, as pilots, we use the chair fly term. We'll sit there and pretend like we're flying, and we'll do this and pretend we're doing this switch, and then we'll do this next step, put the aircraft at a certain attitude or pitch, or the throttles at a certain spot. You'll rehearse this ahead of time so that when your body is in a situation where it needs to be able to make decisions quickly, it knows what to do. And you can apply a similar mindset to preparing your team for a deployment or some kind of combat training scenario at Fort Polk or something, where you know exactly what to do because you've been through this scenario before. Even if you've never been through this scenario before, your body knows how to react to it. So you don't panic, you don't lock in your losses. If you sell at the bottom, you never know if it's really the bottom or if it's going to go down further. And then you never know when to get back in. You have to time it right perfectly twice. And that's darn near impossible to do.
Market timing is very impossible to do. One thing that I really encourage the listener to do is, on like a tactical level, delete the trading apps from your phone. So if you have a Roth IRA at Vanguard, Schwab, Fidelity, just delete the app from your phone. You still have access to it if you go through your computer, but just adding that little bit of friction and adding that little bit of, okay, I have to log in here. Okay, I have to remember my password. Okay, I have to get the two faster. By the time you get in, you're like, I don't even want to deal with this thing anymore. And that's great. Don't. There's that apocryphal study. It always changes, whether it's Schwab or Fidelity. And they're looking at the best performing 401k accounts at their brokerage firms. And the best performing ones were the ones where the owners were dead because they just didn't trade. Apparently, that's not entirely true. There was no study like that performed. But it makes the point that the less that you're taking action, the less that you're trying to be ahead of the market, rather than just kind of like be in the flow, the best way to do that for most military service members is to make automatic contributions to your TSP every paycheck. If you can get to the point where you're maxing out your TSP and make contributions to your Roth IRA, just do that every paycheck or every month or on the 1st or 2nd of January of every year so that you're maxed out for the year. Do that for your spouse as well, and set it and forget it. You can use a target date retirement fund like the life cycle funds and the TSP. And then you don't even have to think about what asset allocation you want. It just automatically sets it. If it's, a lot of people are afraid of the life cycle funds because, they add too many bonds eventually. It's in like 20 years. So it's okay. You have plenty of time to adjust fire along the way, to educate yourself and to eventually build a portfolio that you're comfortable with. But if you're like, what's the difference between a stock and a bond again? Then don't worry about it. Just pick a life cycle fund. Like, we have made investing so army proof. It's amazing. And it really is one of the great things about being an investor in 2025 is that, yes, you have a lot of options and, it's really easy to generate a lot of FOMO. But if you have a good strategy and you write it down and you can stick to it, and no matter, if the stock market's down 19% or up 7%, then that's good. That's the kind of strategy that's going to get you to financial success in only a few short years.
Yeah, the automatic piece of this is really important because it takes away that emotional reaction that you might have. And then you feel the emotions, or you might feel a little bit of panic, but then you just implement what you decided when you weren't under panic, when your brain was at its peak optimized performance. You made the best decision possible, not under duress. And then you realize, hey, this is the 21st correction of greater than 10% in the S&P 500 in the last 50 years. And then you don't touch anything and you just acknowledge that it's there. But when it's automated, you're buying on the way down, you're buying on the way up. And if you took your money out and stopped buying or turned off any future contributions because you're afraid of it, you would have missed one of the greatest recoveries in modern history. It went up something like, it's back up, like did quite a huge swing in a couple months. I forget what the numbers are, but greater than the 20, 27, 25% swing in a couple months is a pretty sweet recovery. As you're doing automated investing, it's just buying at the beginning of the month, at the middle of the month, whatever you do, but buying on the way down, buying on the way up, because you're a long-term investor and you're looking 20, 30, 40. In some cases, if you've already achieved some level of financial independence, your investing horizon may be 100 years or more. You might be investing now for your great grandkids. And if the world is still around and America is still a country by then like your money is going to continue to increase compared to what it is now. So keep that in mind. And again, now's the time to think about like, what do we do in the future? What do we learn about this? Like, how did you feel? Did you know this was going on? I wanted to sell, you didn't, and we ended up not selling. Like, how do we feel about that decision now? Or you wanted to sell, I didn't, so we ended up selling. And like, now, how do we feel about this? Did we get back in on time? Did we miss the recovery? And those are great things to just kind of debrief and talk about with your friends or your spouse.
One of the key things I want to leave the listener with is, if you made the mistake of selling on April 9th and missing the recovery that's now we're positive year to date, that's okay. Like, we all make mistakes. And the bigger mistake here would be to stay out of the market. So get back in and don't think about all the returns that you lost or that you didn't accrue. But the bigger mistake here is to say, well, I just can't trust the stock market because, as soon as I make a move, then it starts reversing, going the other way. You're right. Like, you can't trust the stock market. So the best thing to do is have a strategy, write it down, and set it and forget it, and keep implementing, keep saving, keep investing through the good times and the bad, and understand what you're investing in. So like, when you're putting money into the TSP, it's not this like magical black box where the money just disappears. No, like, you're buying actual shares of actual US and international companies that produce actual products, employ actual people, and they're building the future, right? Like, if you're investing in the C fund, that has Microsoft in there. Microsoft owns a big portion of OpenAI, which produces ChatGPT. So every time you're using ChatGPT, you're probably helping out your Microsoft stock a little bit. That's the critical thing that I want you to take this opportunity, that if the April stock market drop was a significant emotional event, that's okay. Investing can be an emotional roller coaster. But now that things have calmed down a little bit, take the time, debrief, assess. And if you were 100% stocks, which I know a lot of military people are because we have a very high tolerance for risk, then maybe it's time that you're like, look, like, it's, I could be 90% stocks, and that's still extremely high tolerance for risk and has a tremendous potential to grow, compound over the next 20, 30, 40 years. But it's okay to have a little bit of bonds in there too, so that your entire portfolio isn't swinging up and down every time the US stock market does.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.